Hello, welcome to this video on profit maximization. So in this video we're going to look at two things: the conditions for profit maximization and what that means. And firstly, we're going to look at the difference between normal and supernormal profit. So let's start off with normal profit. So the profit is difference between the revenue and the costs. It's also the difference between the price and the average cost if we're talking about per unit. Now we would say the business, the entrepreneur who runs the business, is making normal profit if the profit they're earning is enough for them to stay in that industry, i.e. it's enough for them to keep the money they've invested, to keep the workers in their current use in that business in the long run. So what we're saying here is that the funds would not be better off used elsewhere. So when we look at the opportunity cost of using these funds in this particular business, they're at least equivalent to the alternative use. So for example, if I have £200,000 in a business, I could have put that money into a low risk bank account and earned a rate of interest. So I need to make sure that my money invested in this business is generating me a level of profit that's at least equivalent to that low risk rate of return. Otherwise, I would move my money from the business into that account. Now, as economists, when we're looking at business, we include this opportunity cost as part of our costs. We say there are the kind of basic accounting costs, the raw materials and so on, but then we also include this opportunity cost. So average cost curve includes this return on our assets that we would otherwise get with an alternative investment. So as long as the price covers these costs, including the opportunity cost, the return we could have got elsewhere, then we would say the firm is making normal profits, and it will stay using those factors in that particular industry in the long run. So as long as price is equal to the average cost, and that average cost includes this measure of return we could have had elsewhere, then we would say normal profit is being made if the price is the same as the average cost. Let's have a little look more at this idea of what we mean here by normal economic profit. We're really talking here about an economic profit rather than a business profit. So let's consider the data below. We have some data here. We have revenue, money coming into the business, £30,000. We have some costs, 13,000, 8,000, 3,000. Now down here we have the salary the owner could have earned elsewhere, 3,000, and the interest foregone on the capital invested. So if we had invested money, instead of in the business, we put it in the bank, we could have earned this interest here, the 3,000. So in a simple accounting sense, in a very simple kind of traditional business sense, the business has a total revenue of 30,000 and total cost of 24,000, 13, 8 and 3. So that means the business is giving an accounting profit of £6,000. Now, from an economic sense, actually what we've said previously is that we also want to include in our cost curve the opportunity cost of the capital invested and any other opportunity cost. So, for example, here the income the owner could have earned elsewhere. So if the owner had stayed in their previous job, they could have put the money in the bank account and they could have also earned that other salary. So we're going to also include these in our costs. We're saying as part of our costs we need to earn this return, otherwise we wouldn't really stay within this business. So it's kind of a cost from an economic sense. If we take this into account, we find that from an economic perspective the profit is zero. The price equals, or the revenue equals all the costs, including the opportunity cost. So we would say that this business is making a normal profit. We've included that return, and so the business will keep. It wouldn't be better to stop the business and take up the other job and put your money in the bank account. So this table illustrates quite nicely, accounting costs, things like raw materials, wages and salaries, interest paid. These are traditional business costs, and we would call them, we call that an accounting cost, and that would give us an accounting profit. When we're looking at economics costs, and when we're looking at the average cost curve in this unit, we're also including the opportunity costs. So we're saying we need to earn these returns as well. These are part of our costs for us to stay within this business. And so if the revenue covers all of these costs exactly, we would say the business is earning a normal profit. So what do we mean by supernormal profit? Well, profit in it that is achieved in excess, above the level of normal profit, sometimes known as abnormal profit. So we get supernormal profits are made when the revenue is greater than the economic cost, or if the price is greater than the average cost, if the average cost includes the opportunity cost that we've talked about previously. When firms are making this supernormal or abnormal profit, then there's going to be an incentive for other producers to enter the market to acquire some of this profit. So in terms of our table before, if our revenue covers our economic costs, so all our accounting costs plus the opportunity costs, and we have money left over, then we're making a supernormal profit. Now let's move on and look at profit maximization and the conditions for profit maximization. Here we have a table showing some information about a business. And on the left-hand side, we have the price per unit, which, as we've discussed in previous videos, is the same as the average revenue. And we can see as we lower the price by 2 over time, we have a corresponding increase in demand. This column here shows us the total revenue, so the price times the level of demand. And then here we have the marginal revenue. So from that additional unit, from those additional units, how much revenue has changed by. So here increasing by 6 units has led to this increase in revenue. So across our 6 unit, the 6th unit, the last unit, has increased revenue by 37. So we have our marginal revenue, which we've seen again previously. Here we have total costs. And again, we have marginal costs. So adding that 39th unit, what's been the impact on cost? Well, it's increased cost by 20. Adding the 45th unit, the impact on cost has been an increase of 17, and so on. If we take the total revenue and we subtract the total cost, we get the level of profit the business is making. So here we have the level of profit the business is making at different given levels of output. And we're going to try and derive a rule here that our business can use, so we can quickly work out what is the profit maximizing level of output and a profit maximizing price. So we can see our table here again, and if we were to plot it out, our table, we can see the blue line here is the revenue and the red line here is the cost. Now where the cost is higher than the revenue, we are making a loss. Where the revenue is higher than the cost, we are making a profit. Where the two match, where revenue equals cost, we are making a normal profit. So if we have a look quickly at this, can we spot here where the profit maximizing level of output is? Well, it's a little bit tricky, but it's basically where the gap between the blue line and the red line is the greatest. Now down here in this table, I know it's at an output of 36 and a price of 36 and an output of 75. We have 162 of profit, which is the largest level of profit this business can make. So that is this gap here between 2,700 and 2,534. But you can't see it that easily from this diagram. So what we do is we look at the relationship between marginal revenue, marginal cost, and profit. So here on the right-hand axis, we have the profit plotted, and we can see the profit here going from a loss to positive, and then there's our maximum profit of 166. And can we look at the relationship between the maximum profit here and what's happening with the marginal revenue and the marginal cost? Now we've looked at these curves previously, but what we can say is that the marginal revenue is the additional extra revenue we get from that particular unit. So from the 63rd unit that we sell, it brings in 21 in revenue and it adds 10 to our costs. So this 63rd unit is profitable. It will increase our profits by making and selling this unit. 21 comes in, only 10 goes out. And that's the case for all the units as long as the marginal revenue is greater than the marginal cost. And that is the case for this 75th unit here. We can see that it brings in 13 and only costs 9 more to produce. Once we go beyond that point, this point here, actually the marginal cost, the extra cost associated with the 81st unit is greater than the extra revenue that unit brings in. So profit is maximized if we sell those units up until the point where marginal revenue equals marginal cost. So profit is maximized where marginal revenue equals marginal cost. So how do we illustrate that more simply when we're looking at a particular business or a particular market? Well, we draw our marginal revenue curve and our marginal cost curve. And where marginal profit is positive, those units bring in more money than they add to costs. So we want them to be produced. They're generating profit for the business. However, where marginal cost is bigger than marginal revenue, those units, actually, we don't really want to produce those units because the money they're bringing in is less than the money they're adding to costs. So profit is maximized where we produce the quantity Q1. If we produce up to the point where marginal revenue equals marginal cost, then we can be sure that as a business we're making the biggest amount of profit. So profit is maximized where marginal revenue equals marginal cost. That is our rule. So how do we illustrate that? How do we illustrate now that we are generating a normal level of profit, for example, at that particular point? Well, we need to add on our average revenue and our average cost curves. And we've looked at this previously, but we know that the average revenue curve, our demand curve, is half as steep as our marginal revenue curve. And we know that our average cost curve goes down while marginal costs are below it. And then once marginal costs are above it, then it starts to rise. So here is our level of output at which we maximize profit, Q1. And so what is the price that we're charging at Q1? Well, at Q1 we go up to the demand curve, the average revenue curve, and we find out the price, which would be P1. And what is the cost at a level of output of Q1? Well, to find out the cost of producing each unit, we go up to the average cost curve and we find out it's C1. And here, because the price is the same as the average cost, we are making normal profit. Because remember, we've assumed the average cost curve includes the opportunity cost. And the total profit the business would be making would be P1 minus C1 times Q1. So here it would be 0. So the total revenue would be equaling the total cost. The price equals the average cost. And as the average cost includes the opportunity cost of investment, the business here is making a normal profit. So let's make sure we take this diagram down. Okay, now let's have a look at a situation in which the business is earning a supernormal profit. Again, to find the profit maximizing output, we look at where marginal cost equals marginal revenue, and we find out that's Q1. We then add in our demand curve, our average revenue, and our average cost curve. And this time what we can see is that when we produce output Q1 and we ask ourselves what is the price, we go up to the demand curve, the average revenue curve, and we find that price is P1. At this level of output, what is the average cost? Well, we go up to the average cost curve and we find that the average cost is C1. Now here the price is greater than the average cost, and the average cost here includes all those opportunity costs. So we're making a profit even greater than normal profit. We're making supernormal profit. And the supernormal profit will be represented by this area here. How would we show a business that's making a loss? Well, here we have our same rules apply, marginal revenue, marginal cost. The business will choose to produce this many units. And if we draw it like this, when we look at Q1 level of output, when we go up to find out the price, we find that there's a price, an average price here of P1, and there is an average cost here of C1. Now here the average cost is greater than the price, so this business must be making a loss. And basically the profit maximizing level of output here is minimizing the losses. It's the minimum level of loss that this business can make. And the loss, the economic loss, would be represented by that area there. One more scenario for us to consider here. We have a business here that's producing at level Q1, that is the profit maximizing level of output, and we can see that there's quite a big supernormal profit being made at this level. P1 is much greater than C1. If there was an increase in demand in this industry, well, we know that increase in demand shifts the demand curve to the right. And if the demand curve is shifted, AR is shifted to the right, the demand curve shifted to the right, but also the marginal revenue will also shift. So both curves, MR-AR, shifts to MR2, AR2. And so here we get a new set of profit maximization scenarios. So what is our rule? Profit maximization occurs where the marginal revenue, so marginal revenue 2, equals the marginal cost. So here's our new profit maximizing level of output, Q2. We go up and find the price, and the price is P2. The costs haven't changed, so we look for our new average cost, which is up from Q2, which is C2, and so we have a new supernormal profit. So supernormal profit has increased from this initial area here to this new area here as a result of the increase in demand. So in this video we've looked at the conditions for profit maximization, and importantly we've looked at how we would illustrate a business making normal profit, supernormal profit, and an economic loss. We've also introduced the concepts here of normal profits, which includes an alternative return, an opportunity cost, and supernormal profit, where the price is much greater than the average cost, or the revenue is greater than the economic costs. That's it. Thanks very much for listening.